Hello and welcome to Macros with Mythili, our weekly program where we take a hard look at all the major macroeconomic issues and developments in India and overseas. Well, rather than zero in on a single issue or development for discussion this week, we're going to be discussing a whole gamut of macroeconomic issues with a very special guest. We are privileged to have with us Dr. Duvvuri Subbarao, who, as RBI governor during the worst years of the global financial crisis, had the unenviable and perhaps a slightly thankless job of heading the central bank in the face of a far-from-benign external environment and at times not very supportive political environment at home as well. Welcome to the show, Dr. Subbarao, and thank you so much for speaking to ET Now in your first interaction with the Indian media after leaving the Reserve Bank of India in September 2013.
Thank you, Mythili. Thank you for having me on the show.
Well, if I may start with asking you, how different is the macroeconomic situation today than from what it was when you left the Reserve Bank in 2013?
Well, you know, every policymaker believes that his or her time is the most challenging. But if you really take an objective view, the situation today is far better than it was in 2013. Go back to 2013, we had growth falling, inflation going up, the rupee declining, the balance of payments under pressure, the current account deficit way above the sustainable limit, investment sentiment was negative, and fiscal deficit, for all the commendable efforts of former Finance Minister Chidambaram, was still very high. If you look at today, growth is trending up, inflation is trending down, the rupee is steady, balance of payments is quite sturdy, foreign exchange reserves are at the highest level ever, current account deficit is significantly below the sustainable limit, public finances are on the mend, and investment sentiment is positive. You know, apart from all the macroeconomic parameters, if you take the political economy perspective as well, today is a lot different from 2013. 2013, we had a government which, by the Prime Minister's own admission, was weighed down by coalition pressures, and by 2013 had already got into an election mode when every decision was evaluated against electoral calculations. Whereas today we have a government that has no coalition pressures to speak of, has 4 years in office more, can take decisions with a reasonably long-term perspective, even within the electoral calendar. So I believe that in 2013 we were struggling with stabilization. Today we're struggling with structural adjustment.
Well, I'll ask you a little later in the program how much has monetary policy contributed to the better situation. But before I do that, let me just turn my attention to the monetary policy framework agreement that has been signed between the Reserve Bank of India and the government. Given the dominance of the fisc over monetary policy in India, has the agreement really weakened or strengthened the RBI's hands?
Yes, Mythili, that's one way of looking at it. Yes, the fiscal dominance is always there, has been there, but as we look forward, we'll look into a situation where the fiscal dominance will come down. The public finances will be on the mend, both at the center and in the states. So the pressure that comes on inflation and on the monetary policy stance from the fiscal stance will, I expect, be diminished. But if you take a more objective view, the monetary policy framework can be seen as quite transformative because the Reserve Bank, you know, the objective function of the Reserve Bank's reaction function currently and during my tenure were quite diffuse, quite opaque. Whatever the Reserve Bank did could be explained as a way as being consistent with the policy. Not that the Reserve Bank acted arbitrarily, but it looked arbitrary from the outside. So the monetary policy framework gives credibility, predictability, transparency, and contestability to the Reserve Bank's actions.
Yes, absolutely. There are going to be challenges in the Reserve Bank of India, and one of the unknowns in the Monetary Policy Framework Agreement is really about the composition of the MPC, the Monetary Policy Committee. What, to your mind, should the composition be, and will the proposed MPC really reduce the tensions between the Reserve Bank of India and the government, which are inevitable perhaps in any democracy, but have come to play in a big way in the Indian context?
Well, there are many open questions about the proposed MPC. How many members will there be? How many from within the RBI? How many from outside? Will there be a government official on the MPC? Will the members be full-time or part-time? How will they be chosen, etc.? I do not know what the government is going to decide on this, but let me give you my views on some of these issues. First of all, I feel very strongly that there should be no government official on the MPC, because having a government official, no matter how professional he is, how unbiased he or she is going to inhibit free and frank discussion in the MPC. I can say this because I was finance secretary, I was the governor, and I believe having a government nominee there is going to vitiate the quality of discussion there. Yes, the government will have a say. There is a mechanism today of the governor consulting, not consulting so much, but giving his view to the finance minister and the prime minister before every policy review, and taking into account their point of view, not necessarily doing what they want, but certainly listening to their point of view. That can be institutionalized. For example, the finance secretary can come and explain to the governor the government's point of view. But I believe having a government official is not a good thing.
As someone who has spent some years in the Reserve Bank of India, Dr. Subbarao, I could not agree with you more as far as the government functionary on the MPC is concerned. But I'm not sure your former IAS colleagues will speak to you very much after hearing that comment. Yeah. But if I may switch to something else that is closely related to this and the entire issue of inflation control, the recent fall in inflation that we've seen, is that a result more of fortuitous circumstances, or is it because of astute monetary policy? Because if you remember, starting from April 2009, you had actually raised interest rates 13 times before April 2012. You first cut interest rates to give growth a chance. In contrast, the recent regime in the Reserve Bank of India, rates have been raised just thrice, but yet inflation fell. So what does this mean about monetary policy? Is it completely useless? Are the lags too large? Or is it that sometimes credit is given where it is perhaps not quite warranted and credit is denied where it was warranted? How do you see the decline in inflation in recent times?
Well, I've always held, even as the governor and now as the ex-governor, that in a country like India, admittedly, inflation stems from supply-side constraints more often than not, except in a few episodes of inflation when demand was the main driver. But we've always held that monetary policy has to be the first line of defense, because if inflation persists for long enough, it gets generalized. And monetary policy has to act to anchor inflation expectations. So to that extent, I believe monetary policy has an impact no matter what the driver of inflation. But to say that the Reserve Bank has no role at all, I think would be taking on quite an erroneous stand.
Absolutely. To say that the Reserve Bank of India has no role at all would be taking a very extreme stand. But in fact, on that note, we have to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing a whole gamut of macroeconomic issues with none other than Dr. Duvvuri Subbarao, who in his first interaction with the media after he has stepped down as RBI governor is explaining to us the macroeconomic issues facing the country, the Reserve Bank of India, the monetary policy framework, and a whole host of other things. Dr. Subbarao, before the break, we were talking about RBI monetary policy and about the monetary policy framework agreement. But if I can look at just inflation targeting, and if I can quote something that you had once said about inflation targeting, and you mentioned this little earlier, you said that inflation targeting in India is difficult because much of inflation comes from supply shocks, and supply shocks are less amenable for correction by monetary policy. So whether the RBI will be able to deliver on an inflation target will depend on how the structure of inflation changes. Have your views changed since then? And if not, will the primacy that is now being given to inflation targeting really impact RBI's credibility as an inflation targeter?
Well, yes, we discussed that before the break. Certainly, inflation in India has several drivers. As I said a short while ago, inflation stems from supply-side pressures and therefore less amenable to monetary pressures, but monetary policy stance. But monetary policy has to be the first line of defense.
Maybe give it a fair chance, Dr. Subbarao, but in a country where the FRBM targets, in fact, something that has been passed by Parliament, has been violated repeatedly, I don't know how much sanctity there is really about a letter from the Reserve Bank of India governor. Particularly, and if you see this, as things stand, there's nothing about making it public. So one really doesn't know. And what kind of damage will it do to RBI's credibility if the RBI is repeatedly falls short short of that target one way or the other? Because if you remember what they used to say about the German Bundesbank, not every German might believe in God, but they all believe in the Bundesbank. So will that credibility of the Reserve Bank of India be affected if the Reserve Bank is not able to reach the target, whatever the governor may say in his letter?
Well, if the Reserve Bank consistently over a long period deviates from the target and fails to meet the target, certainly credibility of the Reserve Bank will be affected. But hopefully we will not get into that sort of a situation. And mind you, sufficient safeguard has been built in. The 4% inflation target has quite a wide tolerance band. So I think this is a way to go forward.
You know, one of the problems facing the Reserve Bank of India every time it tries to do something about inflation is what they call the poor monetary transmission. The fact that when the RBI either cuts rates or increases rates, banks don't really follow suit. But recently we've seen the RBI talking down to the banks and telling them, almost arm twisting, quote unquote, that they should lower their rates. Now, is that the way we want to go, or should there be some way of improving the monetary transmission?
Well, there are several impediments to monetary transmission. The Reserve Bank is aware of that. The government is aware of that. The markets are aware of that. There is fiscal deficit, for example, has a big say on monetary transmission. The administered interest rate and whatever influence that the government has on public sector banks as the owner, that also had an impact on monetary policy transmission. But I believe all these institutional arrangements are on the mend. Fiscal deficit is on the mend. The government has said that they will not interfere in the professional functioning of the banks. And administered interest rate has, that regime has dismantled over time. And the last vestiges that are remaining, we expect that they will go down in course of time. So there are challenges, but over time, I believe that the risks will be mitigated.
I do hope you're right, Dr. Subbarao, but the RBI has a number of roles. So will the focus on price stability take away from the RBI's role as far as growth and financial stability are concerned?
I don't believe so, because price stability has always been the dominant concern of the Reserve Bank, like of any central bank. Growth and financial stability after the crisis have come on the radar screen. Growth always, but financial stability more explicitly after the crisis. Yes, before the monetary policy framework, RBI used to say that we're having a multiple indicator approach: growth, financial stability, and price stability. But what weights were given at each point of time to which variable was very unclear. That's why I believe that this inflation targeting framework will be a better driver of the monetary policy stance, but it by no means implies that the RBI Reserve Bank will completely ignore growth and financial stability concern. That's not the case. It's got to take a very, very, I would say, thoughtless governor to believe that it's going to drive inflation irrespective of other concerns. And fortunately, the Reserve Bank has had a tradition of, I'm a bit embarrassed to say it, but being headed by people who've always held the public interest above everything else.
Oh yes, I can entirely second that. But if you look at exchange control management, which is also one of the RBI's roles, there's a general feeling that RBI doesn't walk the talk when it comes to exchange rate management. Is that a correct view?
Well, that's a question that's crossed my mind several times when I was in the Reserve Bank, even after I left the Reserve Bank, whether RBI actually follows its policy. Let's see, what is the Reserve Bank's policy? The Reserve Bank's policy is to let the market forces determine the exchange rate and intervene only if there is excess volatility. But what is volatility, what is excess, has not been defined. So whatever the Reserve Bank does can be explained away as being consistent with the stated policy. Going back to, my thoughts go back to 2010-11, we had lots of capital surge coming in and the rupee was appreciating. I've been criticized after time for not intervening in the market, not buying up dollars, building up the reserves that would have stood us in good stead during the crisis. But my point was that if the rupee was appreciating gradually, there was no volatility, how could I have intervened in the market and remained consistent with the policy? So there is, if you say that RBI does not walk the talk, there is some truth in that. Several times I used to ask my RBI staff that, look, we should change our policy. But they always said, why should we tie our hands? No central bank has a clear-cut, publicly announced exchange rate policy. Therefore, their view is that they shouldn't tie their hands very much. But I believe this is an area where the Reserve Bank must restate its policy, review and restate its policy.
But is the Reserve Bank as it stands today sufficiently accountable for its policies and actions? And what can we do to make it a little bit more transparent?
You mean relating to exchange rate?
Exchange rate, other policies also. There's a general feeling that the Reserve Bank is still not as accountable as it should be in a democracy particularly.
Oh, that is true, certainly. You know, that's something that I've always believed, that the Reserve Bank is a public policy institution. It makes decisions that affect the daily lives of hundreds of millions of people, but it's run by unelected technocrats. Is that consistent with democracy? This arrangement of a political central bank run by technocrats is not unique to India. But what's unique in India, what's different is that we have no institutions of accountability. How does the Reserve Bank render accountability? By helping the finance minister answer parliament questions, by the governor going before parliament committee meetings which are closed door, which are on specific subjects, and through media interactions. But I believe that sort of accountability is both inadequate and not structured. So we should move towards a more institutionalized form of the Reserve Bank rendering accountability. And one way of doing that is for the governor going before the finance committee of the parliament at least twice a year, presenting the Reserve Bank's performance and results and explaining the actions and answering questions from members of parliament. You know, that not only gives an institutional mechanism for the Reserve Bank giving accountability, but it will also shield the Reserve Bank from pressures from the political executive.
Oh, absolutely.
Because it establishes contact with the legislature.
Absolutely. I couldn't agree with you more, because there's a great need for the Reserve Bank of India to be much more accountable. I do hope both the finance minister and the governor are listening to that, because when it comes from somebody like you, it carries a great deal of weight. But I'm afraid on that note, we have to slip into another very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the macroeconomic situation and what could be done and what cannot be done with a very special guest, Dr. Duvvuri Subbarao, the former governor of the Reserve Bank of India. There are one or two, recommendations of the FSLRC that find place in the finance bill, which gravely damage the RBI's position as far as, price stability, etc. is concerned. So, is it that, can one say that with the wisdom of hindsight, that the Reserve Bank was not sufficiently proactive, did not wake up to the dangers of the FSLRC's recommendations? Because this is not the only one. There also is a recommendation regulation, which again would impact the RBI. So how do you look at these FSLRC recommendations, particularly the ones that are there in the finance bill?
Well, first of all, your first part of your question about whether the Reserve Bank was aware of what the FSLRC was going to recommend, we were given an opportunity, just one opportunity, to present our point of view along with all the other regulators before the FSLRC Sri Krishna Commission, and we presented our point of view. We requested for other opportunities to present our point of view before the FSLRC, but were not given. Okay, there was just one other opportunity given informally for me to go and meet Justice Sri Krishna and another member, but beyond that, no formal opportunity was provided. Now, about some of the recommendations, the Reserve Bank institutionally has taken certain positions, and the recommendations are quite contrary to that. Take, for example, the PDMA. Okay, there is what is the argument for hiving off the debt management function from the Reserve Bank? The argument seems to be that the Reserve Bank makes monetary policy, and Reserve Bank's monetary policy stance is going to be unduly influenced by its need to keep the interest cost for government debt low. That's the argument, right? And I can tell you, having been in the government, having been governor of the Reserve Bank for 5 years, that is a misperception. There is no truth in that at all. Government, of course, pleads for low interest rates, but never has it, either in public or in private, said, please keep interest rates low because the cost of debt is going high. They've asked for low interest rates for other reasons, not because of the cost of the debt. And in the Reserve Bank, in the entire 5 years, there have been several variables, several considerations that have gone into monetary policy making, but never has it been an issue that, look, what is it going to do to the government borrowing? So I believe that the conflict of interest issue is completely misunderstood. And there are other safeguards. There's always been the safeguard of the FRBM, and the FRBM is continuing. The inflation targeting framework is further safeguard against the Reserve Bank's monetary policy being influenced by extraneous considerations. And there's a conflict of interest for the government.
Absolutely. Unfortunately, I think people haven't thought through and seen the FSRC recommendations as being completely academic and not very practical. Unfortunately, the government seems to be going ahead with many of those recommendations without really thinking them through. Well, one last question, Dr. Subbarao, before I let you go. With the benefit of hindsight, what would you have done differently during your tenure in the Reserve Bank of India if you were to do it now?
Well, first of all, that's a question that several people have asked me. That's a question that's crossed my mind several times in the last 1.5 years. My tenure in the Reserve Bank, 3 phases. First, the global financial crisis, then inflation management for much of 2010, 11, and 12, and the fight against the rupee fall in 2012 and 2013. If you take the first phase, global financial crisis, maybe we could have tweaked marginally, but I don't believe that we would have done anything differently. I don't have very much to say that we would have done anything differently. On inflation management, the biggest criticism against my monetary policy stance has been that we did not tighten more aggressively, faster, higher rates, etc. Yes, looking back, I believe that there is some merit in that argument that the baby step approach was inappropriate. But remember, our critics were making the criticism with the benefit of hindsight.
And would the government have supported you if you would have tightened faster? Remember, you had a finance minister who made his wishes known very clearly.
Yeah. The government, of course, wanted low interest rates. There was no secret about it. And support, I do not know what you mean by support, but the government would certainly have been disappointed, to use a mild word, if it tightened more aggressively. But that's not the main consideration. The main consideration for tightening less aggressively than the situation would have required was the global situation. What was the reality at that time? The Eurozone financial crisis, sovereign debt crisis, was in full bloom. There were concerns about financial stability around the world. Capital flows were still coming in copiously into India because of QE, which was at its peak at that time. And several central banks, most notably ECB, had raised interest rates and then backtracked. So all these considerations were in our mind when we had tightened perhaps in a more measured fashion. That's about inflation. Now, let me talk a little bit about the fight against the rupee. The rupee had fallen quite significantly because of the taper tantrums. I think 2 things I should have done differently. 1, communication. 2, the actions. On communication, I was trying to communicate 2 messages. The first message was that the Reserve Bank will defend the rupee against excess volatility. The second message was a little more complex, which was to say that the bleeding of the rupee was inevitable because we'd run a current account deficit way above a sustainable limit. We were financing that current account deficit through fickle money, which is flowing in because of QE policies in advanced economies. This is not a sustainable situation. Therefore, the depreciation of the rupee was programmed into the macroeconomic situation. The earlier we pay the price for it, the better. But there were 2 conflicting messages, and saying them simultaneously, I believe, was maybe an error of judgment. But why was I saying that? Why did I want to communicate about the bleeding? Because there was a myth going around that our rupee going down is because of the external situation. I wanted to correct that. I wanted to say that no, this is not much to do with external situation. The taper tantrum is just a proximate cause. The reason the rupee declined was because of our own structural reasons. And also, I wanted to warn private corporates that the Reserve Bank cannot be the risk manager for private corporates. The Reserve Bank is the risk manager for the economy. It cannot be the risk manager for private corporates. So if they borrowed in foreign currency, they have a responsibility to hedge their foreign currency exposure, but they cannot expect the Reserve Bank to come and protect them. And the only way to prepare them for that is to let them pay the cost. So all these things got jumbled up, and I believe that I should have handled the communication better. And finally, on actions, Mythili, I think the August 14 action of imposing controls on capital that resident Indians can take out, resident corporates can take out, I think that was, with the benefit of hindsight, it looks like an error of judgment. But you know, because it had a much greater negative impact than we thought. In the Reserve Bank, the thinking was that this would signal the intent of the Reserve Bank to defend the rupee, but it was seen as there is India regressing from its capital liberalization measures.
Oh, absolutely, Dr. Subbarao. It's much easier for people to criticize than to actually do. So would you concur with Dr. Manmohan saying that the RBI governor's job is the loneliest job in India?
Well, I don't have Dr. Manmohan Singh's CV. He's held every economic job in the country, so he's much better positioned to say that. But yes, certainly in the Reserve Bank, I was in the IAS, I worked in the government. Moving to the Reserve Bank was a different job altogether, because in the government you're working in a system. There is the ministers, there is the entire system that helps you, and when you take a decision, there is checks and balances. Whereas in the Reserve Bank, the buck literally stops with you, so you feel responsible. So it is certainly a big transition for me, and certainly a very enriching experience.
Well, thank you so much, Dr. Subbarao, for sharing your views, not just on the macroeconomic situation today, but also looking back on your time in RBI and what could and could not have been done differently. Thank you so much also for watching. But we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.